Hello, my name is Kieran. I'm the Head of Aviation Advisory for KPMG. On behalf of KPMG and Airline Economics, I'm delighted to be joined by Tom Baker. Tom is the CEO of Aviation Capital, and he's here with us today in relation to our Leaders Report for 2025. I should say we're recording this in Singapore in early November 2024. Tom, as always, it's a pleasure to have you with us.
Thank you for having me.
And maybe before we start into the meat of it, you might maybe say a few words about ACG and maybe the year.
Sure. I mean, as a reminder, ACG, we're a core narrow-body lessor based in California, owned by Tokyo Century, which is a Tokyo Stock Exchange listed specialty finance company. We're a fully owned subsidiary of TC. It's been a good year for us. We've continued to grow to the extent we can in all four channels, which is we've added incrementally to our order book to the point now we've got about 160 aircraft on order, a little bit more evenly balanced toward Airbus and Boeing. We've grown in the sale-leaseback channel. We've grown actively in the trading channel. And then that fourth channel, M&A, is one where we're continuing to look but haven't seen anything compelling yet. So executing on all cylinders. We're about 515 aircraft now owned, managed, and committed. And the industry itself has been through probably about 18 months of stability right now, which is a very unusual, welcome but unusual dynamic for us. And so now you're really starting to see our business starting to perform in the way to its potential, which is a pretty exciting and encouraging feeling.
Absolutely. And Tom, ACG has circa kind of 90 customers, 45 odd countries. So you probably have a very strong view of what the demand environment is like kind of across global geography. And how do you think, what are your concerns around that general economic environment, and what are the kind of operational challenges that customers are facing?
Sure. Yes, and IATA just published some numbers in September to support the fact people are flying. People are flying at all time volumes. So, and as everyone knows, we're tied, generally speaking, to global macroeconomic growth, which has been constructive. So that part feels good, feels sustainable. Yields are coming off, ticket prices, particularly for more economically sensitive airline carriers, low-cost carriers and others. That is returning more to more normal dynamics. And as everyone knows, the margin between success and failure, between profitability and loss for airlines is very narrow. And so we'll be interested to see how that continues to evolve over time. Cost pressures are increasing. And there are some airlines that are very well run, that have good networks, good business strategy, good management teams, good fleet strategy. Those will continue to do fine. Those airlines who don't have seamless networks, perhaps not the right fleet strategy, management is not executing to the best of their abilities, those will continue to struggle to the point where if you look at every major geography around the world, there is at least one major carrier facing a restructuring, going through a restructuring, or rumored to be entering a restructuring. So that, even in a very constructive macroeconomic dynamic where people are flying, there will be scenarios always where airlines will struggle and some will have to restructure.
And clearly that's on the demand side. Then, look, we've fairly well publicised issues on the supply side. I suppose, how do you think that will evolve over the medium term?
In a very frustrating,
or very long term, maybe.
In a very frustrating and unsatisfying way. I think this is something that we as an industry will grind through for years and years. And it's the airframers, it's the airframe aggregator, the Airbus and the Boeing, it's the engine OEMs, and it's the manufacturer and delivery of the assets, but particularly on the engine side, it's the reliability, the durability, and what is the overall maintenance cost of that asset over time. That create tremendous uncertainty, unpredictability in an industry where we need certainty and we need predictability. And so anyone who's not concerned doesn't have a pulse. And I think anybody who can tell us when it's going to end or how it's going to look has no clue. And so I think it's something that we're all going to have to grind through. And unfortunately, the airlines bear the biggest brunt of all this volatility and uncertainty and cost. And so it's, to your earlier question, is to, in a generally constructive and benign environment, it's helping the airlines manage through these challenges.
And clearly it's an inhibitor, right, for growth, for different things, for fleet replacement, whatever. Is that having an impact on the lease rates and even down to lease request extensions? Has that journey changed, has the narrative changed on that in the last while?
Sure, of course. I mean, it's fundamental supply-demand dynamics, and clearly they're not making new airplanes, so there's a supply constraint, and that will only become more acute over time. And so yes, the acceleration in lease rates over the past couple of years is very well known. I think people do like to talk about the fact that there's been a little pause in the market. I think some of that related to a sudden shift downward in interest rates a few months ago, which now seems to have reversed itself a little bit. So it'll be interesting. There's a little bit of a lag. And it's winter, so not as many people are taking aircraft or extending. And so we'll see how that flows through over time. I think there are those who say that lease rates have peaked or are coming down. There are those who would say that lease rates are to a point where airlines can stay. It's the market, it's supply, it's demand, and it is tied to interest rates. And I think if interest rates are returning to a more normal, higher for longer, I think you'll see lease rates continuing to trend back toward where they were heading probably 6 months ago. Now, is that super high? No, I think we're entering much more of a narrow band, but I don't think you're going to see them return back down to levels that we saw a year ago or 2 years ago.
Yeah. And of course, the reality is we're not returning to 20 years ago how high interest rates were, so it's not unreasonable we won't go back to the very lowest either, if that makes sense.
Yep.
You mentioned, the four legs of the business, and trading being one of them. We're seeing relatively active trading market, but we're also seeing lots of people saying it's quite pricey or different. How has that been for ACG in terms of that?
Sure. No, I mean, it's, lessors go through four channels, as I had mentioned earlier. There's the order book, sale leaseback, lessor on lessor violence, which is secondary market trading, and M&A. Because of the constraints at the OEMs, the order book and the sale leaseback channels are challenging. You're just not seeing the volumes, you're not seeing the opportunities to actually commit capital. And so you see the lessor community writ large focusing much more on that third leg of the stool. Certainly, some of it is interest rates, some of it is supply demand, some of it is that hunger for growth. There are very healthy bids in the market. But everybody has different needs for something. And so, there have been years where we had not been able to right-size the portfolio, manage the shape of risks and exposures in certain places, sell for us mid-life aircraft, older aircraft, where that's just not our core specialty. And so there's this inventory, this pent-up collection of aircraft where we're now actually finally getting to recycle that capital. And I think a lot of lessors are doing that. So there are some natural portfolio exchanges going on that make sense and make money for a lot of people. Certainly selling at great gains, probably buying it a little bit higher, but it makes sense over the life of the lease. At some point, though, collectively across the industry, you can't keep retrading the same aircraft. So for a period of time, I think we'll continue to see a very strong bid, particularly if the ABS market comes back, because then you get those smaller players looking to top up their warehouse or their aggregated assets for that ABS takeout. So it will continue to remain strong, but you can only trade the same pool of aircraft for so long before I think ultimately you then force people to that fourth leg of the stool, which is the M&A piece.
And we'll come back to M&A in a minute, but actually back to the ABS. So we've obviously seen more ABS activity in the last little while. Do you think that'll continue to grow over the next 12 months?
So I think, if you look back to the last time the aircraft ABS market shut for an extended period of time, which was 10, 11, 12 years ago, it stayed closed for about 3 years. Yeah. Investors need time to forget. I think you're going to see a similar dynamic. You know, I mean, a lot of people are saying that the ABS market has reopened in 2024. It has not. It's not open. Have there been some trades? It's the necessary things that need to happen. There need to be some, you know, investor-friendly, issuer-unfriendly, chunky kind of structures to get that muscle memory back, to bring the investors back to the table. That is what's starting right now, and I think that as long as doesn't need to be a low interest rate environment, it needs to be a moderately constructive, stable interest rate environment. Investors coming back, macro backdrop still looking generally positive. I think 2025 you're going to see you know, a robust ABS market start to form. Very good. In aircraft land, obviously ABS is in other places.
Yeah. So. And maybe shifting to or staying with kind of the aviation debt market. So you recently closed a $1 billion unsecured facility. So again, really sizable, really impressive. How do ASG think about, let's say, traditional banking space versus alternative lenders versus unsecured bond? How does that look for you?
I think the lessors of scale, so I'll call them the top 10, top 11, top 12 global lessors of scale, are quite privileged now, and typically, but particularly now, in that we have access and opportunity in lots of different pockets of capital with lots of different pools of investors in many different parts of the world. You know, so the bank market's open to us, the bond market's open to us, in Asia, in the US, in Europe, in the Middle East increasingly. And so really for all of the lessors of scale who have access to, who have investment grade ratings or have otherwise credit enhancers that provide them differentiated access, it's really just picking strategically whether it's flexibility, whether it's diversification of funding sources, whether it's cost, what are they trying to achieve, and then attacking that opportunity set. But they're there. Yeah. I think for the smaller lessors who rely on structured vehicles, who have to match fund against the asset, that opportunity is much less flexible, smaller, not as deep, perhaps probably more expensive. Yeah. So for us, I think you're going to continue to see us just kind of revolve as the opportunity kind of presents itself, and on a relative basis, something is better than others. But there's no dearth of opportunity for us at this point.
And staying with facilities for a second, so you've also done your inaugural sustainability linked loan, which I think was a 550 million security and a 300 accordion. So talk us through that and look, your view on environmental concerns and their impact on the sector.
Sure. I know things ebb and flow with time. Yeah. We committed to an ESG strategy a couple of years ago. We're committed to that strategy. We're going to. You got to start somewhere. The tools that we have available to us in the toolkit are a little bit limited in the sense that it's aviation. But we got to at least test it out, take our steps, keep moving toward that goal. There will be times when people pay more attention to it. There will be times when people pay less attention to it. We're just going to keep chipping away and making our way toward what our long-term goals are. It's super important to our shareholder, Tokyo Century. So I think you'll just continue to see us execute our ESG strategy. Obviously, a big piece of it is taking new technology, fuel-efficient aircraft. We're at the mercy of others on that one, and so you'll continue to see us trying to chip away at other stuff around the margin until those aircraft deliver.
Excellent. And so you're owned by Tokyo Century, and are you seeing changes in the types of investors that are attracted to aviation, and even how people perceive it as an asset class versus other asset classes?
Honestly, I want to know who these people are.
Yeah.
It's just when you think we've convinced people that aviation is a tough industry, more and more keep finding their way in.
Yeah.
So the short answer is more investors, more money, more capital continue to come into the space from all different angles. I think it's a more complex industry. I think it's a harder industry to make risk-adjusted excess rents in. But that doesn't discourage or dissuade people. I am moderately constructive. I'm quite constructive on the long-term fundamentals of the industry, and particularly of this cycle over the next several years. But that doesn't necessarily mean it's going to be easy to make money. And I think you're going to continue to see people come into this space, realize it's much harder than they expect, and then exit this space. And so you'll see that kind of. And then I think over time you're going to see the people who are long-term committed to this, to committing capital, and you'll see people who continue to try and fail and move on. But certainly there's going to be no shortage of new entrants. I mean, I guess I thought there would be coming out of COVID and then coming out of Russia, but clearly there are not. So
no, if anything,
come on in. Come on in.
Imagine, a good crisis to get new people to look at something.
Yeah, I mean, so the crisis brought the distressed people in, and then they realized that you didn't get the or very few got the distressed return. So now they're exiting, you know, and then you're going to get the momentum investors that come in, and they're going to realize that there's only so much momentum.
And clearly that bit, right, you know, the fourth leg of the business you talked about was M&A, and, you know, we've new entrants who will, look, clearly some will leave, that's typical, right? And we've had some M&A this year, not loads, but some. Do you think that will continue? And clearly scale is more important than it was before, so do you think that will continue to drive it?
I do, just because, you know, we're a maturing industry. And when you look at the history, you know, it's pretty straightforward what happens when industries mature. Ultimately, they consolidate because, again, it's harder for a multiplicity of players to earn excess rents. I also think now, because of the supply constraints we discussed, it's harder to grow. It's harder to find new metal. And so I think you're going to find those who had growth objectives, who have a certain pocket of capital, they need to put this much to work and this number of assets, and this type of assets, they're going to struggle to do that. And so I think it's just a natural evolution of a maturing industry. I also do think that the scale benefits will continue to flex their muscles through this upcycle. So if you have a large installed base of aircraft and service on long-term lease, and you have an order book, and you have investment grade ratings and a global network, that, you know, you're really strong. We're starting to monetize the benefits of those attributes. Whereas before, assets were available, money was cheap, nobody had to deal with repossessing or taking back an airplane. You know, those days are gone. So I think you are going to see those who have that capability, have those collection of winning attributes will continue to outperform, and will be the consolidators of the smaller people who cannot grow, don't have those attributes, are not earning those returns.
Yeah, and it's similar to what we discussed last year, which is in the past it might have been easy, now you need to be good.
Yes, yeah, absolutely. Yeah. The other thing about our industry, everything takes so damn long.
Exactly.
And so it's so, you know, it's writ large, it's coming, but you know, it just takes, everything takes a very, very long time. Yeah. Like they say, it's all very, very slow until it's very sudden.
Exactly.
So we'll see. It could be next year, it could be the year after, it could be after we're gone.
Absolutely. And we might finish what we typically finish with, which is looking over the next 12 months, what are your optimism levels?
So this is aviation. So optimists die
very quickly,
lonely and heartbroken. So I think so certainly I've learned not to be an optimist. Yeah. Having said that, again, if you look at the structural dynamics that really drive our industry, fundamentally speaking, you know, the macro factors are generally constructive. The supply constraints are real and acute, and will challenge growth, but improve profitability in the sense that it will force people into a discipline that they would otherwise be tempted to forsake for shiny new stuff. So, you know, there's a lot of pieces that come together to suggest that, unfortunately, the highs will be lower, but the lowers will be higher. You know, so we're going to have we are investing with the conviction that you will have a narrower but gently upwardly sloping cycle over the next many years, at least to the end of the decade. With some, there'll be some volatility along the way. And so the way we think about running our business is what is the right way, on a risk-adjusted way, protecting ourselves from not getting crazy optimistic and leaning into things, but how do we pick our spots and how do we grow, assuming that there'll be a little bit more of a tailwind than there will be a headwind.
Very good.
Which is a good place to be.
Absolutely. And like anything, any sector needs less volatility to ultimately get more.
I've given up on that.
But someday.
Yeah, even as we talked about earlier, I don't know if it's been 18 months, 15 months, 20 months, but we've had what feels like an extended period of stability in our space, which is enjoyable, but it's also allowed not just ACG, but I think other operators to really focus on the business. Making sure the right people are in the right place. It's people, process, and systems at the end of the day from an operating perspective. So I think this stability has also allowed, again, at least these top 10 lessors, maybe more, but the peers that we pay attention to, everybody's running a tighter ship. Everybody's running a really, I think, on balance, well-managed asset manager platforms, which is also encouraging to see because we've had the time to actually think about making things work better, as opposed to panicking, putting out fires, chasing customers. So it's been a pretty interesting and exciting time.
Great. So Tom, as always, thank you so much for the generosity both of your time and your insights into the sector and what is a fantastic business in ACG. Thank you.
Thank you so much. Appreciate it.